Which is
Are we
happening.
live? Hello, hello. Welcome back to Real Talk New York, the premier podcast to get all things New York real estate. I am Hirsch,
And I'm Chris.
and today we're having a little bit of a different episode. The last one was mostly an introduction to both of us and what got us interested in New York real estate in the first place. And today we have something very exciting. We're going to be discussing some trends in the market and things to look out for.
Important trends in the market. And the market is definitely shifting, so you definitely want to tune in and get as much information from this as possible.
Yeah, and things are going to get into the weeds a little bit. Things are going to get nerdy a little bit. It might be deep in there. But if you have questions, email realtalknewyorkpod@gmail.com. Leave us a comment. Of course, always, as always, like and subscribe. All the fancy jargon word
All that
things,
good
all
stuff,
that good
right?
stuff. Do it down there. All right, cool. So, Chris, we've been seeing a lot in these last I want to say 8 weeks at this point for 2024. We've seen a lot of different trends come in. Things are changing. The climate is shifting. What have you been seeing? What are you noticing? What's jumping out at you right now?
Well, there's a lot of optimism in the market right now. Everyone feels like this spring market, this summer market is going to make up for what we lacked in 2023. There's a lot of optimism though, and there's some buyers coming out of the woodwork. Some people who just can't
Mm-hmm.
wait any longer. They have to buy. They have to move, regardless of the rates, regardless of
Amen.
economic factors. So we're seeing that happen now.
Yeah, to speak to that for a little bit, part of the reason is a lot of buyers sat on the bench last year, decided to take time off from the market, and as a result, what New York saw on the rental side, something that we didn't necessarily touch on in the data points that we're going to go over, but something that just jumped out at me and I realized right now is that rents went pretty crazy over the last 8 9 months, right? Because all those buyers that sat the bench got to live somewhere.
Right.
So the demand for rents went up and rent prices went crazy. And part of the reasoning I'm hearing from buyers on the street anecdotally is that if I'm going to be putting out in a course of a 12-month lease what's equivalent to a down payment for a home, and that's money just gone forever,
Might
right?
as well buy. Right.
Yeah, exactly, exactly. And so, yeah, talk to me a little bit more about, in these last 6 to 8 weeks, what are some of the really highlights of what's causing this optimism, and what's the juxtaposition or what's the contrast? What's it been like? And the shift is optimistic, right? So like what was it before? What was some of the causes? And then we'll both expand on that a little bit.
Okay. So the very first thing that changed the market was interest rates going through the roof,
Mm-hmm.
mortgage rates going through the roof.
Mm-hmm.
3 years ago, you're able to get a mortgage at 3%, and then
Yeah.
the next thing you know, mortgage rates are 8%.
Talk about a sweetheart deal.
Right. And so what happened there is now it's a problem because buyers don't want to pay that amount
Mm-hmm.
for a mortgage.
Mm-hmm.
And if they do pay that amount for a mortgage, now they can't afford the home that they wanted to buy because
Right.
the rates are so
Their
high.
purchasing power is suppressed.
Right. The next thing that happened was sellers don't want to sell
Mm-hmm.
because if you bought at 2.5% and now
Right.
you have to sell, now you have to, when you do move and buy again, you're
Right.
buying at 8%. You're triple, almost quadruple what you
Unless
bought in
unless
for.
you change markets, right? Unless
Right.
you switch out from New York and move, like go snowbird and go to Florida, Atlanta, somewhere else, right? Where you could, perhaps get a really nice home that in New York might be something similar, might be like $2 million, but
Right.
down there might be like 700K, 500K, and then we're talking different game. But a lot of people that are just transitioning within the city itself and are changing because their family dynamic changed, looking to downsize or upsize because they're expecting babies or having more kids and don't have that space, or now they're empty nesters and they're looking to downsize and go into a smaller living situation that's a little more comfortable. And ultimately properties to people are their nest egg too, so
Yep.
have something for retirement. But buying in an interest rate climate when you just refinance, perhaps even in 2019 2020 at like 3% or something close, coming back into a market climate where it's like 8 9, some people 9, depending on credit and debt to income ratios and all those good factors. That's tough.
Right.
That's tough to
Right.
say the least, for sure.
Um,
And yeah, you
yeah,
were
I
going to
was,
say
I was
something.
also going to add too, with the mixture of low inventory and
Mm-hmm.
high mortgage rates,
Mm-hmm.
you would think that the low inventory homes would go,
Right.
but they have still been sitting,
They sat.
you know,
They sat.
and also with some seasonality too. Like, the months
For sure.
of September to December are typically slower months anyway,
Right.
but it was even slower than what
Right.
we've normally seen.
Right. Yeah, no, exactly. It's seasonality is a trend that continues and prevails. It's just that same trend line on a lower part of the graph, if I'm making sense. Like what would have been a trend line with, for example, 1,000 units sold across 3 months or what have you, 6 months or what have you. That same trend is, like the seasonality curve is happening, but on a lower part of the graph.
Right.
So you're seeing that same kind of swooping bell curve up and down and up again towards the end of the fall season a little bit and then
Right.
back down, but just happening on a lower portion of the graph. So lower numbers, just suppressed numbers across the whole board, across the market.
But there is hope for
Mm-hmm.
2024. Everyone's very optimistic about this market that's
Yes,
coming up, and the data is supporting that as
data
well.
supporting it. Yes, I do want to caution that you want to be aware of, yes, it is a resurgence. Yes, things are looking up. And we're going to go deep into the numbers soon here. I know we're kind of building up to it right here, but you want to keep that in mind that, it's going to be relative to the last 18 months. It's not going to be anything close to probably what we saw when rates were 3-4%. We don't anticipate anything like that happening this year, at least as far as we can see. I'm not clairvoyant. Maybe Jerome Powell pulls some levers and something else happens in the market that we can't foresee. COVID certainly would be an example of that. So we can't speak to things that aren't foreseeable,
Right.
but relative to the last 18 months, we're seeing much better traction this year come back. And it's a strong swing towards a more normal market, which juxtaposed with what we've seen in the last 18 months is a significant improvement. And that's really what we're seeing, optimism in terms of relative to the last 18 months.
And if you are a buyer and you're waiting for rates to go down to 3%, 4%, do not do that. It will not happen.
It won't happen.
We've spoken with many experts and in the mortgage industry and in the financial industry, and 5% is probably something that it may possibly hit at some point, but that is going to be years and years and years down the
That's
road.
going to be, yeah, at least 2 years, minimum 2 years, I think. Could be longer, but that shouldn't stop you from pulling the trigger now, because there's some very creative mortgage products out there. That's, we're getting sidetracked here, but there, you should certainly explore the opportunity, especially if you think you can afford to buy, if you think that you're ready to pull that trigger. If you're a first time buyer or you're looking to resell and buy something else, you should certainly explore the opportunity with as many lenders and see what comes back at you, right? Because they don't always have to do a hard pull and suppress your credit to get you that information on what pre-approval, what your purchasing power looks like. So at minimum, given what we're expecting this year from both the supply side with more inventory entering the market, and we're going to go over numbers soon, as well as more buyers and more activity just as a whole, it's a great time to start exploring those things, especially as we're starting to enter into spring and that active season is about to kick in. Seasonality, of course, so that bell curve swoops up towards the middle of June, stays pretty high up there throughout August, and then it starts to peter out from that point, kicks back again later in the fall after some of those holidays, but then peters out quite substantially past that point. That's just a normal New York trend line for the market in general. Most people also look to buy and close on the home and move in by August, because schools usually start in the fall and they have to organize other family priorities as well, along with this purchase of their next property and what have you. And when their leases run out, all those things factor into it. All right, great. So we can finally get into some numbers here, my kind of thing. So we're seeing substantial changes, like we said. Liquidity is increasing, and the seasonal run up to this spring busy season in the last 5 weeks, we're seeing a resurgence of activity, more supply side activity, more demand side activity as well, more contracts signed and more listings closed in this January and this February of 2024 when you transpose those figures over 2023. Lot more on both sides. So very, very healthy signs towards a busy and active spring. How do you feel about that?
I mean, I agree. So again, like the all the lines are trending upward. I'm seeing more buyers in the market. Listings are getting more activity, more inquiries, more showings. Open houses are becoming more populated.
Mm-hmm.
So it is an election year. We could talk about that at another point, another time. But
Yes.
yeah, I'm starting to see like
Yeah, more traffic all around, right?
hmm
More
hmm
traffic everywhere. So month over month, we're seeing an uptick right now of 3%, which is still below on the supply side, below by lower by about 3.8% in the last year, year over year. So this time last year, we had 3.8% more listings on the market. But month over month, that is a significant uptick and speaks to a very normal trend heading into the spring market. Some of the things that led to the conditions that we saw in the current climate. There was a progressive decline, like we said, in contract activity. Just a lot of buyers sat the bench, sat out, didn't want to participate. A lot of sellers did the same, so inventory was tight, and it created a very interesting dynamic in the market, something that was unexpected, and I think most realtors had a hard time really
what do you
explaining
say?
that.
What do you
Yeah.
say? How do you tell a buyer like to buy at 8%? Like you could say, oh, rates go down, you refinance. Yeah, that
hmm
sounds good. But in the beginning, that person has to put down
At
a nice hefty
yeah,
lump sum.
at the
Where's your
bottom
hand at?
line, like what I could have bought was a $1.5 million 2 bed condo on the Upper East Side, and now I'm looking at a $1.1 million co-op,
Right.
right? So it's a very different product that I'm able to purchase now with those higher interest rates, and
Right. And on the flip side of that, it's hard to tell a seller to sell your 2.5% mortgage, your 2.8% mortgage,
right,
and then buy into an 8% mortgage
right,
because so as we're getting some some ease on those interest rates, we're going to see a
yes.
real boom.
Yes, and speaking of that, so Jerome Powell, the head of the Fed, last we heard from him, as I recall it, earlier in this year. Um, Previously, we planned on having 4 interest rate reductions. Then some December net numbers came in on inflation, and there was some more volatility than previously anticipated, and that led to Jerome Powell reanalyzing and reassessing and saying, no, we're going to keep things as is probably in March when we meet. And then when the Fed meets again on the second quarter, still expect 3 25 basis point decreases on the federal funds rate, which should translate into some good improvements on mortgage rates as the year progresses, as we get through 2024 across the board. So not as good news as we had hoped, but better because previously what happened was we saw 4 consecutive increases in the federal funds rate,
Big
and
ones.
then big ones that led to a very rapid increase. The market had a tough time adjusting. That's another thing that I'm seeing too. Is people were it was such a stark and rapid contrast between rates when they went from 3 up to 8 that climb that quickly really came as a wallop to everyone that was looking at buying a product last year, and so they that really put the brakes on their interest level towards buying, because no pun intended. No pun intended, because of their ability to purchase just really rapidly declined. And now that that's had some breathing room, people have come around to the notion of what a normal market is supposed to look like. We had some frenzied situations, right, where there was multiple offers, bidding wars, things like that happen in the last 3 years. We're going really deep here on that, but and then that rapid change up into the other direction, and that very heavy cool down. Of course, it affected New York too, and that's really what we saw. But we're starting to see, that steady deterioration in the listing climate is starting to turn around. It's bottomed out, and it's made a turnaround. So bottom line is, right now, what we're seeing is that the peak leverage portion of buyers having more leverage in negotiations has started to wither away. It's become a thing of the past. And so they've got to adjust their expectations. They got to adjust that the understand that the market's no longer as favorable to them. It sounds weird saying that because it's like I had 8% interest rates. How the heck is that supposed to be a favorable market for me, right? But it's favorable to you because there aren't as many buyers.
Yeah,
Demand is lower,
yeah.
so you hold more cards.
Listings were cold.
If you come into a listing and make an offer and you're a serious buyer, you have to get entertained because that listing is not seeing as much action as it was maybe 12, maybe 8 months ago. So that's definitely giving you more power and leverage in negotiations when you're a buyer in that type of market environment, even though there aren't many of you then because most people just chose to sat out. But I tried to explain that to a lot of my clients. But
It's a lot like the stock market too.
Mhm.
What did Warren Buffett say? When there's blood in the streets, that's when you buy, right? That's when you make a purchase because
Right.
that's where the deals are.
Right.
If you wait until everyone else is buying,
Right.
like just think about that. You wait till when everyone else is buying, you're going to be in line,
Mhm.
open houses,
Mhm.
bidding wars, and things of that nature. So when
There were times where there were lines out the block.
right, when no one's there to buy, that's when you buy.
Right.
That's when you get the
That's when
deals.
and in real estate, I don't know who said this first, but I've always lived by this principle and I believe in it 100%. The money is made on the purchase. The real estate return on investment is made on the purchase itself. And the better deal you can get, because here's what you can change. You can refinance and change your interest rate. Here's what you can't change: how much you paid for that property.
Right.
Right? That's locked in. Whatever your offer got accepted at,
Right.
that you decided to proceed with, if it was a property that was supposed to be at market value 400,000, but you paid 500 for it because you loved it that much, you better hope the next person loves it as much because odds are you're going to get something like more like 450 5 years down the line and lose 50K potentially on that purchase. So
Right.
have a good advisor with you that can do the comps, that can do the appraisals, get the appraisal done, review all of that information, make your offer accordingly, and negotiate accordingly. Right.
Right. And another thing too, when prices are lower at an 8% interest rate, you're buying at a lower price.
Right.
When interest rates come down, you can refinance, but then your home is also going to be worth more.
Right.
So you can really refinance
Right.
and sell if you want
You
to.
can
And
you
make
can
a quick profit.
immediately see that appreciation come
Right.
back into your pocket. Absolutely. So very good points, very good things to be talking about, to be thinking about right now if you're a buyer out there, especially, and also if you're a seller out there. There's a good time to be thinking about these things and thinking if it's time maybe to re-enter the market. I think a lot of
Sorry, not to cut you off, but for sellers, I think this is definitely the opportune time to list and get your homes on the market. Between the months of April to June, as Hirsch said,
Yeah.
that's that window.
That's that window.
If you can catch that window,
that ramp up. If you catch it on that ramp up, you can sell it before it peters out. That's the hope, and that's the strategy, really. So right now what we're seeing is a return back to a neutral landscape. So basically over the last, and we can share these charts and things in the list in the description below. We will include a link to the newsletter that we publish, and that is going to have the charts that we're looking at right now to give you this data. But what I'm looking at right now is the market pulse, and what the market pulse is basically a ratio that analyzes contract activity versus listing being taken off the market, versus supply levels adding into the market. And so looking at all of that, we can gauge what the pulse of the market is, where the negotiability is, and the seasonally adjusted market indicator. It analyzes supply and contract on a 30-day contract activity trend. I know this sounds like German to most people, but basically it's showing that now we're moving away from a more buyer-centric to a more neutral market, more balanced market. So sellers come in with those adjusted expectations too. We saw a price decline on average across the Manhattan market of about 10% on prices, period, because rates were high, demand was low, as we've gone over. So we haven't recovered all of that 10% yet.
No.
And don't expect that to necessarily happen overnight either. What we are seeing though is that the bottom has capped, the turnaround has happened, and we are now in neutral territory. So, but I would like to add that, buyers and sellers still have a little bit more of an edge here, because sellers know more than buyers know right now, right? Sellers know what their timeline is. Sellers know how much pressure they have to sell, what their motivation level is, and they know how, they know a few more things.
They
So
know
there's
exactly the number that they
they
would and
would
would not
and
sell
would not sell
for.
for. Exactly. So there's asymmetry in how much information sellers have, and in that sense, there's more power in leverage in being a seller in the market right now than a buyer. But on the whole, numbers tell us it's more of a neutral market right now. All right. So moving on. So what's the next thing we're going to touch on here, Chris? Do you want to introduce that part?
Well, I was going to say for sellers in
Mm-hmm.
this upcoming market, there are a few things you want to be aware of. Price points are going to be very, very, very important in this
Mm-hmm.
upcoming market. I know price is
Mm-hmm.
always important, but
Yes.
in this coming market, with the influx of buyers that are coming in, a lot of first-time buyers
Mm-hmm.
who just really don't know the pricing and how that
Mm-hmm.
stuff works. Pricing your home accurately is going to be very, very important.
Yes. Oh, I have to double down on this. Yeah, absolutely. I mean, of course, prices are always important. And I know as a seller sitting there, you want to get the most you can for your property. And it's counterintuitive how to do that. A lot of sellers don't understand. And even when you try to explain it to them, because there's so much emotional attachment, it's very difficult to let go of that and just look at data as for data's sake and information for information's sake and be objective when we're talking about the most valuable asset I will ever own. It's
Biggest purchase in most people's
biggest purchase
lives.
of everyone's life, mostly, right? So the way to do that, the way to do an accurate pricing, especially in the kind of market that we're anticipating in the coming months, and we'll do a market report on a monthly, quarterly basis. So we will continue to revisit this and see and track this and continue to deliver this information to everyone that's listening and that's watching and that's following on the other platforms and reading our newsletter. So one of the things that's important is you want to price at the market. You want to accurately price the property, not because that may potentially mean to you that it's not the right number that you were hoping to get out of the property, but because that's the way you get the most interest in the shortest amount of time. And the more interest you can generate and cultivate, the more traffic, the more offers you get, the more there's an opportunity to have multiple offers and compete and negotiate off of each other, right? And that's what we call typically a bidding war. Doesn't mean it will always happen, but it's a game of likelihoods. It's a game of probability. You want to give yourself the best opportunity, the best chance. So pricing at or just slightly below the market doesn't have to be a significant amount. Could be 5,000, could be 10,000, could be 25,000. It's all relative to the overall listing price. If it's a $3 million listing, $20,000 may not mean as much as if it's $1 million listing, right? And you're at 980 instead, and that's because of mansion tax and a million other things. But generally speaking, relative to the price point of the market, if you come in exactly at or just slightly below the market, within the first 30 to 90 days, the odds of you generating an offer sooner than your competitors being the comparable listings in your
The
area,
correctly priced listings.
yes, you can use those other listings that are incorrectly priced and leverage them to your advantage to get a quicker sale and potentially even a better price than those other listings because you generate more interest, multiple offers, right?
I want to add to that for sellers too. I know this is going to be a tough one, a tough pill to swallow.
Mm,
But if you're selling your home, the best thing to do in terms of commission split is giving at least 5 to 6%, because a home looks more attractive
mm-hmm.
at a 2.5% split, at a 3% split,
Yes. We
than it does
look.
at a 1% split.
You can say we have an inherent bias. You wouldn't be wrong to say that
It's true.
because we are brokers in New York.
Yes.
But bottom line is 9 out of 10 deals that happen in New York, that happen on the market, happen between two brokers representing their respective parties. They
Right.
don't happen for sale by owner. That doesn't mean you can't be a for sale by owner, and you can certainly test the waters, test the market, and depending on your motivation, you might not even really want to sell.
We're gonna have another. We'll have another episode.
Yeah,
about
that's a
escrows.
whole
That's
other topic.
That's a whole other
But
ballgame.
just quickly touching on that because we're on that subject, yes, you want to price accurately. You want to price at or just slightly below the market. because it is ultimately still a neutral market. No one has more of a one up on each other. Sellers just maybe a smidge because of the asymmetrical level of information that they have on their particular property. But at the same time, they don't have the information for the property surrounding them. So today you look at the active competition next to you, next door neighbor, whoever in the building over. They might be selling for slightly higher than what you're pricing at with a very comparable type of home, but 20 days goes by and you don't know. They might have such a rush to get out of there more so than you do. They might attract a buyer quicker by having accepted a lower offer that you just didn't know they would be willing to accept that, right? So that's another factor to consider if you're sitting there thinking and running the cogs in your brain about how to go about this process. But the best thing you could do is get a very competent agent. These guys, no, just shop around for that too, right? Find the right agent, find as much information as you can, use it to your benefit. You have informational leverage, not necessarily negotiational leverage, but informational leverage, and use that to your advantage.
And I will add one more thing too with sellers. Don't be surprised if you put your home on the market and you do get some low offers out the gate, because buyers are still figuring out these new levels where pricing.
They're still reeling from this wall up
from the lack of inventory.
Right.
So if you do get a lower offer,
right,
it may happen. And if you do want to stand your ground, of course you have every right to do so. But just be prepared for that.
Another thing I wanted to talk about is something called a listing success, and how we measure that. We use UrbanDigs for all our data sources, by the way. All our data, that is the most neutral, unbiased, just raw, best data source that exists for New York information. So huge shout out to Noah Rosenblatt and John Walkup for creating this platform, for sticking with it for so long, for continually improving it, and for continually providing transparency when it comes to New York real estate. Okay, so moving forward. So listing success, what does that really measure? Listing success measures the percentage of monthly new listings that were signed into contract within the first 90 days of listing. And so the rolling seasonal average shows us that it's about 30%. So a third of all listings at all price points, period, currently roughly a third, just below a third, currently are able to get on and off the market with an offer in contract within the first 90 days, about 30% of them. So that leaves a huge opportunity for other sellers on the market right now, because I can tell you 9 out of 10 times it's price. It's not the marketing. It's not the lack of publishing it in luxury magazines and having it on TV shows and syndicated channel networks and marketing it in the local movie theaters and all that stuff. Yes, that looks great for your agent to do for you, and it does help. It gets more eyeballs, sure. But ultimately, if you're not priced right, there isn't going to be an offer, and if you are, there will be at least one, but ideally more. Right? So 30%. So that means there's a huge gap in the market for sellers to take advantage of that by, one, having a competent agent appraise their home, maybe even paying for a bank appraisal to get the most accurate information you can. All right, moving forward. So what's the next subject? I want you to introduce it.
Well, we went over listing success.
Yes.
The upcoming market for the spring, summer.
Right.
I'd rather talk more to buyers and sellers directly about what to expect.
Sure.
Coming up in this upcoming market, and I would caution buyers to not wait until you hear the news. Once you hear the news on the news, it's too late. It's too late. You want to get out in front of it. You want to get out ahead of it, because if you wait until the news hits, you will hit the market with everyone else, and you do not want to do that. It's all about supply and demand. If there's one bottle of water left in a room and there's 10 people, the price of that water bottle just went up.
Yeah. But I got news for you.
If there's 10 water bottles in a room and you're the only person looking to buy, you might be able to get 2 for 1. Right? Who knows? Right. So it's all about timing the buy, and I think the time is right now. If you see something you like right now, go for it now, because that price might increase. Right. And again, there will be tons of buyers flooding the market. I'll say as soon as mid-March to early April.
Yeah, if as we're projecting, you're waiting around for summer, first of all, understand timelines, have a competent agent, but understand timelines. If you identify a property today, you put in an offer, at minimum, unless you're a cash buyer, you're getting a mortgage, you're going to look at a 60-day close minimum. And that's for a condo. With a co-op, that's probably 90.
90.
And even with a condo, that can be 90 because the seller could request an extension depending on the specific situation. So account for those things. And if you're looking in June, it's a little late because as we're projecting right now, rates start to come down in June. And as we're hearing from buyers on the street anecdotally, we have a team of 40 agents. So we meet every Monday and we discuss everything we're seeing both at our listings, open house traffic, what's happening with our buyers, are we seeing a resurgence? And so that's what's happening is we're seeing more buyers as the year, even the year started out pretty good because January usually is very slow, and we saw a resurgence of buyer interest in January that sustained and built upon itself in February. We expect that trend to continue because spring seasonality, normally always there's more buyers. And if there's already more buyers than previous year's Feb in this year's Feb, odds are there's going to be more people interested by March, by April, by June. And if rates go down in June, then we're looking at doubling down on that resurgence.
Yep.
Again, I want to caution with being realistic. This is all relative to the last year, right? Not talking about when rates were 3%. That's not what we're talking about. But another thing to consider in this factoring in of information is over the last 40 years, new construction hasn't kept up across the country.
Yeah, there's still a shortage of homes.
Exactly. So that demand purely got repressed. All those buyers purely got repressed by interest rates. Any fluctuation downward is going to cause a resurgence, and people will be looking to immediately make offers if they've already done some digging, some footwork, some research in the previous year and just sat the bench. They're already a much more informed buyer coming back. And if you're not that person because you just started considering it, now that's new information that just got relayed to you. You got to go find you a very competent agent that can really relay all of this to you and explain to you, and has good lenders to refer to you, good attorneys to refer to you, and can really break all of this down and is experienced.
Perch, I have a question for you. Do you see any neighborhoods specifically that are uptrending more than others, or even downtrending more than others
Mm.
at this point? Or maybe Manhattan versus Brooklyn? What are you seeing? What areas should buyers be hyper focused on?
I mean, I personally have a bias towards the Upper East Side, so I always look to first time buyers. I always look towards, hey, you're a first time buyer. I probably want to stick around for like 5 to 7 years before you look to sell, and like your family grows. And so typically for typical first time buyers is like a young couple or like a young person, and either scenario soon within the next 5 to 8 years they will be either getting married, are already married, have a kid, having a kid, having another kid. That kind of scenario is the
Yeah.
typical first time buyer scenario. And what I usually always do is bring them to the Upper East Side because Upper East Side co-ops, price per square foot wise, you just get so much more bang for your buck compared to anywhere else. Um, of course, that doesn't mean that, if you have a specific neighborhood you want to see, it doesn't mean I'm not going to show it to you. Of course, I'll do all the research for you. I'll become prepared, and I'll be the best agent that you've ever worked with, period. Of course. And this is just me marketing myself. But at the end of the day, like that's the neighborhood that I keep an eye on. So why don't we do this? I mean, UrbanDigs is amazing. We can quickly look at listing success, right? Let's do, instead of all of Manhattan, and this is why UrbanDigs is amazing. We'll go to Upper East
Yeah.
Side and we'll just generate a chart for Upper East Side. Period. We won't cap it by any price points or anything else. And what we're seeing is it's very much in line with the rest of the market right now. We're seeing a rolling seasonal average of 29% of the listings in the Upper East Side within the last 90 days have managed to sell within 90 days or get into contract at least, I guess. So that's trailing. Do you have a particular market or territory where you're seeing it trounce the market and outperform the market within the first 2 months? Did you have something in mind?
I believe Williamsburg is moving right now. It may be beating the market. We could look that up now.
Brooklyn generally has been on the whole kind of more beating the market ish. Just because demand always, for some reason, in the last like couple years of real estate, what I've seen is demand is a lot more resilient for Brooklyn than it is for Manhattan lately. And we're seeing that kind of so all of Brooklyn is outperforming all of Manhattan, period.
Yep.
Right, and so that's going to be true of Williamsburg too. But all of Brooklyn listing success, which is getting into contract within the first 90 days on market, is 37%. So that just means that there's a lot more demand for Brooklyn listings and Brooklyn homes.
Up 12% from last year.
Up 12% from last year, up 9% month over month. I mean, it's amazing, right? That's nothing short of amazing and fantastic news for Brooklyn buyers. So if you're not considering Brooklyn, and you have the budget for it, you come prepared with some ammo. You can get a fantastic home in Brooklyn. But Williamsburg, rolling seasonal average, 54% success rate of selling within the first 90 days. But on the whole, I'm sorry to say you're wrong. Williamsburg listing success is down 20% month over month and 46% year over year.
Yikes, that 46%. What do you think that was about?
Down 46%. I mean, I think what it's about is that it's early in the year.
Yeah.
I think that it's too early to call Williamsburg a trailing market for 2024 when we are not even in spring yet, right? So just take everything with a grain of salt. This is a moving 90-day average. So generally, do you see a lot of action between December through February, November through February? That's never the case. Seasonality is a factor here because this is a rolling 90-day average. So we got to look at it within the context of seasonality as well when we look at these numbers, right? But on the whole, Brooklyn is hot. All right. So listing climate. Listing climate is it is a moving average as well. And so I want to talk about listing climate. It looks at the ratio of signed deals to listings being removed from the market. And as that ratio increases, obviously it's a better climate to be listing. And as that ratio falls, it's a worse climate to be listing. And so when we look at all of Manhattan real quick, we are outperforming month year over year right now. So we're up 44% from last month. And month to month, we are seeing more of an improved climate for listing season. We are not in an easy market, but compared to where we were in the fall and towards the back half of 2023, and also even compared to the same time, January of 2023, we are doing a lot better. We saw a slight uptick in January compared to last January as far as listings, going into contract and deals being signed and listings being removed. And we're seeing a lot more in February compared to last February of 2023. And so that if that trend continues, I'm just doubling down on your point here, Chris, that it is the time to list. If there were a good time to list it, I would say mid-March to mid-April, in that window somewhere. Get prepared and get on the market so you can ride that roller coaster of interest that's coming up, and within the first 90 days be one of those 30% that gets into contract. Your chances of success will somewhat suffer if you're listing in July, right? Once you're like close to 4th of July, like a week before and a week after 4th of July is when interest is like kind of wishy-washy. It's still up because it's the peak, but you're like right in the middle of that bell curve. And that means that buyers have already trekked the market, identified some things they like, some things they don't like. There's a lot more inventory you're competing with. There's a lot going on in that peak period. But if you list,
there's also 100 degrees outside too.
Exactly, and so buyers have limited amount of patience for.
And you know how New Yorkers are. Even today was a really nice day. New Yorkers go crazy as soon as the weather changes. So the first thing everyone's going to want to do, which is why I believe, the seasonality is the way it is, because once it starts to become warm, everyone's outside.
Right.
But then once we get used to the heat, or once we have that buyer's fatigue, come August, and also in August people travel for that month and stuff like that. We just don't see as many buyers in the market because, again, as soon as it gets warm, that's when everyone wants to rush and do all those things.
Do all the activities. It's that time for activities, and weekends are for activities. Sundays are the best days to be trekking the market if you're looking to buy for most open houses that they happen on Sundays. But that's also the day that you want to take the kids to the park. You want to walk the dog. You want to get some ice cream. You want to go on a date. You want to whatever else it is that you do in the summer times that the winter suppresses out of you because it is brutal. So you're competing with all of those other factors too that are sharing attention span with your listing, on top of just a number of more listings on the market to compete with, period, across the board. Because not every buyer, right? If you have a listing in Sutton Place, if you have a listing in Murray Hill, yes, your comparables and your market value and your appraisal is all going to be based off of the most comparable stuff in that immediate vicinity. But that doesn't mean your buyer has that limitation. Not in, so your buyer might be looking at Capes Bay. He might be looking at Murray Hill. He might be looking at Sutton Place. He might be looking on the west side. He might be looking in the village. You don't know what their criteria is either. So there's some asymmetry of information that perhaps buyers have that sellers aren't privy to either, that is going to be an important factor in how your listing plays out, or how your search for your next home plays out, to consider there. So yeah, if you're going to list, do it mid March to mid April. You still have some time to make up your mind about it. It doesn't mean that you've lost all hope if you're in the middle of June. If anything, it's the peak of the market. It's still good, but if you're going to list, do it when the ramp up is happening, so you have less competition, less inventory on the market, and buyer interest is starting to really begin to happen in the market, and you can catch some of that early attention before it withers away by just a million other factors. All right. What else did we want to discuss today? So we're going to end. I mean, this whole podcast has been pretty much advice for buyers and sellers based on data-driven statistics and information. But was there more you wanted to add to this conversation right now?
I think we hit all the points we wanted to for this one.
Yeah, I think so too. I think we covered it really well. I would still recommend go and check out the newsletter. If it's not posted in this description of this episode itself, you can still certainly find it if you follow me or follow Chris on any of our socials. I'm at Balla Realty, BHALLA Realty on Instagram, and I'm HARSHIT Harshit Balla, again spelled the same as the last time I said it, on LinkedIn. So on LinkedIn, you can certainly find my newsletter. Also on Instagram, you can click on my link tree and go click on the newsletter to subscribe to it. So you can certainly follow it. It will give you a detailed breakdown with charts, with graphs, with data, with statistics, all the things that I'm summing up in just summary and in speaking. You can see the data that I'm using to insinuate those pieces of information directly there, and that we're using to insinuate that information rather.
Right. And my Instagram handle is IMC Johnson. That is IMCJOHNSON. And my LinkedIn is Chris Johnson. So it'll be linked in the description as well.
Yeah.
Click there and have at it.
Absolutely. Give us a follow. Until next time, guys, this has been Hirsch and Chris from Real Talk New York, your premier source on all things real estate in New York. I don't know if that's our tagline, but that's what I'm saying.
We'll have one soon enough. We'll have a theme song too.
Yes, all those good things are in the works and in the process, but we didn't want to keep you guys from seeing these beautiful faces and hearing these amazing voices while we work on those things. So again, thank you so much for tuning in, and until next time, have a great rest of your day.
Peace.